today we'll be talking about Kenya. What's the economic outlook for Kenya in 2019? And this is for all the investors out there who look to invest in Kenya or are already investing in Kenya. And we are very, very privileged once again to be hosting Jared Osoro, a very seasoned economist in Kenya, based with Kenya Bankers Association. My name is Piers Mushire Mugo, the Managing Director of Nambu Capital, and you're watching Invest in Africa. Jared, karibu sana.
Thank you, Piers, for the invite.
Yeah. Welcome. And you know, Jared, I just want to reflect a couple of years back, what has been happening in Kenya. And I want to start with the pleasantly surprising handshake. And we are now becoming a country of handshakes. Since Uhuru, the President Uhuru and Honorable Raila Odinga shook hands. And we have seen the political calmness that has come with that. The second thing that comes to mind is just the stability of the Kenya shilling, despite all the other African currencies collapsing left, right, and center. Some of them, we never thought that would ever happen. Then there is also some of the concerns that have been arising in the country, the rising debt concerns, the below target revenue collections by the Kenya Revenue Authority, the dual deficit concerns. And also we've since recently launched the standard gauge railway line, which is a good thing but also has come with a bit of a debt concern. Then there's also the interest rate cap, the much talked about interest rate cap, that people never took it seriously. It actually happened and people thought it would be repealed, but it's still with us. So I have very many questions, but I just want to start from this point. Everybody seems to panic about the current debt situation in Kenya. Should we be worried, Jared?
You see, the right to panic or not to panic is given by the Constitution. You may choose to panic, but on a more serious note, I think it depends on what one is looking at.
Yes.
When it comes to debt, I think people usually have a fixation on the quantum of debt, meaning the amount of debt that we owe, either in nominal terms or as a proportion of our output. Now, to me, I look at it slightly differently and say that we need to look at the structure of our debt, in the sense that we now have debt that is split almost 50% domestic and 50% foreign debt. Now, over the last 5 or so years, we've seen debt build up and build up fast. Granted, some of which has gone into the heavy infrastructure that we've seen happen in the economy. Now, if you look at the way the debt has evolved over the last 5 years, there's one attribute that is usually not talked about. We are in the endeavor to diversify our areas where we borrow from, moved gradually though from typical multilateral debt that is usually of a very long term to fairly commercial debt whose tenor is slightly shorter. And that simply means that the average tenor of our debt, on the back of the mix that I talked about of domestic and foreign, has come down. So that simply means that your obligation from time to time have increased as opposed to if the tenor was longer. Now, that is not an attribute that you can pick by simply looking at the quantum of debt. So before you start getting worried, you probably need to look at that aspect. The other aspect that you need to look at is where this debt has been deployed. It's one thing to invest in infrastructure. It's quite another for you to look at the infrastructure that you're investing in, look at the economic rate of return that you're getting out of that infrastructure, and compare that to the cost of the debt that you're carrying to fund that infrastructure. It appears that we took some of the debt and we invested in infrastructure without probably looking at that aspect. So that is why we've seen a number of institutions especially those that are doing what you can call the debt sustainability analysis, that look at the structure of the debt, look at the present value of all the future debt that we have, and compared with matrices like our revenue from taxes, which, as you rightly said, has always been below target. Our export base, which even if we are saying that we are doing okay, it cannot be that vibrant on the back of a weaker global economy. And then point to the fact that we are seeing challenges from our debt situation. Having challenges is not the same thing as occasioning a panic, but it's something that will make you start thinking as to what to do to ensure that it doesn't get out of hand. And one of the options I'll suggest is probably starting to explore seriously the option of seeing whether you can lengthen the maturity profile of our debt. That will help in the sense that it will give scope for the economy to start realizing the benefits of the investment that we've seen in infrastructure, to start realizing the benefits. If you want to do a simple computation, when you have a longer repayment period and you have invested, and therefore the returns of that investment are seen from a longer term perspective, it's very easy for that project to have a very good net present value. And lengthening the maturity profile basically builds into that. So that's one aspect. The other aspect, and this is just to show that I think the debt story has been taken seriously, is the fact that now it's official policy for the government to move into the fiscal consolidation. Fiscal consolidation simply means, it doesn't necessarily mean just simply cutting expenditure left, right, and center. It's rationalizing what you spend in a manner that it doesn't burden the economy, so that it doesn't meet its revenue targets, and therefore resorted to go into the market from time to time. So if fiscal consolidation is to be carried through and successfully, that is one way of ensuring that we don't continue building up the debt that we have. So we are basically looking at the structure of the debt, how that debt is being deployed, and the rate at which you bring more debt on the table. So if you're consolidating, then it means the rate at which you're growing your debt is not going to be that fast as has been before. So there's a need to be cautious, and there's a need to look at the debt story. So anybody who will tell you that ignore debt is not a problem, will be telling you to move your eyes from something that should be of concern to you. That does not to say that you should panic about it.
Okay.
What's our current gearing level, and what's like the threshold?
Well, the thing is, and that's another question that is interesting, but that is not adequately addressed. Debt sustainability is not a function of how much debt you've accumulated. It's, as I said, a number of things have to come into play, because you can be an economy whose debt to GDP is as low as 30%, and you still can be debt unsustainable. And you can be an economy whose debt as a proportion of GDP is as high as 70%, and you still can be sustainable. But that has to depend on some of those things that I've described: the structure of the debt, where it's deployed, whether it's actually carefully committed to, meaning that the projects that are going into it have been carefully analyzed, and they have a reasonable economic rate of return that then will be able to enable the economy, create capacity to meet those debt obligations. The analysis that I've seen from the National Treasury say that on a net present value basis, we can go as high as 70% of GDP. But that is not to give yourself the liberty of saying that if we are at 50, now we can lump it up. It has to be seen in the broader context of how that means from meeting our obligations that they come due. And I think, given the picture that I painted earlier, even if you say that you have a scope of 70, I think there's every reason now to be very, very cautious on how much more debt you're accumulating. And I think there's another narrative to the debt story. And you will start looking at it from the global context, and then you bring it to the domestic context. People say that it's usually good debt management if you borrow and the cost of borrowing is very low. And I mean, that has been the practice. If you want to manage your debt, the timing of the market is when you can borrow cheaply. But if you're going to borrow simply because debt is cheap. You obviously have what you can call social costs that are coming associated with it. And I think there's now emerging analysis and literature about the social costs of government debt when it's cheap. In our case, it's not easy to see where that social cost comes, because if the government is able to borrow cheaply, then it simply means that you will see clear effect of crowding out. And crowding out usually comes with what you can call the welfare costs, because now it simply means that the private sector is not able to get the resources, and private sector employs people. It leads into taxes if it's thriving well. And that is where we find ourselves in a corner now. And that builds into the story of credit. So you have a capped interest rate regime. It was celebrated, but I think it's emerging that those who said that is not a good thing, of course, it has come out clearly that evidence is pointing to that direction, that is not necessarily a good thing. So insisting that we've gone through this far and it has not been repealed and we are still growing is basically being in denial. Because if you are talking about an economy that is growing and growing at the rate at which we are growing, which is an admirable rate, much higher than the continental average, and credit to the private sector from the banking sector is barely crawling, then you have to explain where that growth is coming from and whether that growth can be sustained going forward. So I think that is how you look at the debt situation and how it filters into the domestic economy, bearing in mind that there are welfare costs to some of the debts that you incur, especially if you are going to borrow simply because it's cheap.
It's good that you've already mentioned the interest rate cap is not necessarily a good thing for the country. And maybe it would be good if you can expound a little bit more on this, and because it's how many months now? Is it
from September 2016?
16 years.
Up to now, we've done more than 2 years.
More than 2 years.
Yeah.
So do you have any statistics like what's the impact of the interest rate cap? Or
you see, there are a number of things that point toward the evidence of the impact of the interest rate cap. And for you to see the actual impact of the interest rate cap, you need to look at interest rate as a unique price. Because people look at interest rate simply from the narrow sense of it being the price of credit. They don't look at it as the price of risk. So if you're basically looking at it from the simple that this is it's demand and supply, you forget the fact that when you commit to a credit, the relationship is forward-looking. And therefore, if you're not able to factor in any risks in that relationship, then I think you've completely misunderstood the essence of interest rates. And that's the biggest challenge that we've seen insofar as capping interest rate is concerned. It's simply embedding the assumption in law that people have a more or less similar risk profile. And that's not the case. People have different risks. And if you understand, therefore, that interest rate is a risk price, then you must have an opportunity of ensuring that whoever is going to lend actually is able to distinguish people on the basis of, or the people that they are lending to on the basis of their risk profile. That's just one side of the story. The other side of the story is when you start looking at the overall picture, you know that if you take the monetary policy framework we have, it's an indirect monetary policy framework where you adjust a price and then that price is transmitted through the credit market. That credit market now filters into the economy. That's a transmission mechanism. There are studies that have been done. One notable one is the one by the central bank, which basically says that this law has actually impaired the ability to efficiently conduct monetary policy. So that shifts it from being purely the credit thing to the broader policy picture. And I think that denies the central bank and the economy an important tool of stabilizing the economy. So if, for instance, the central bank wants to respond in a certain manner to bring stability, its answer probably tied So that's another limitation that people didn't think through when they were championing this law. The other is indirect, because if the law was meant to address the cost of credit, and because of the limitations I've identified of not being able to profile the risk and price it appropriately, some of those who are not getting credit from the banking system are getting credit from elsewhere, and that elsewhere is not necessarily cheaper. So that tells you the asymmetric behavior insofar as the attitude towards this expensive credit, because that actually may end up overburdening the already stretched enterprises. And it's no wonder that the slow uptake of credit is a function of squeezed demand, because many businesses may be operating in an environment where they have what we call excess capacity. They have installed capacity that they are not fully utilizing. And for them now to start going for additional capacity, they must utilize the existing capacity up to an optimal level, then they seek additional capacity. So all those things tied together simply point to the fact that probably it was, suddenly it was not the right thing to do. So and the experiments from other countries basically point out that no, those who have tried on that route, it does not come out well. I mean, a number of African economies have tried it. It has not worked. So I don't know whether the thinking was that it's our turn to do the experiment and see maybe this time it will be different, but it has not been different. And I think, broadly speaking, it negates our championing of market principles insofar as running the economy is concerned. So that is really the picture that paints.
And I mean, if it is not working, and I know there has been a lot of noise around that, some from very respectable institutions like IMF. What are we walking through the steps of reversing that effect, or will there be, or will it always be with us?
Well, I can't be able to predict that, but all I can say is that I think as evidence becomes overwhelming that this thing is not working, it will obviously force a rethink. And that rethink could be either modifying it in a manner that can allow the markets to price credit. And I think the timing of that and the form in which it takes is something that I may not be able to point out. But the reality is that I think the evidence is increasingly becoming overwhelming that it has not met its intended objective. And I think, just like you mentioned in your introduction about the handshake and all that, it simply means that as a country, we are people who like looking for our own solutions. We don't have to wait for somebody to lean on us to do the right thing. So I think as evidence comes, I think the right thing will be done.
And I know there has been, I think Honorable Korea has been pushing for some amendment, a sort of a compromise solution. And I think earlier on, what we saw from as people from the outside was a push for complete repeal of the law. Is there any inclination in terms of probabilities where you see probably that is most likely way out of this situation where we find ourselves in?
Whether it's a repeal or some other compromise, so long as it addresses the limitations of enabling the provision of credit and pricing risk appropriately, and not constraining policy. I think those are the two parameters. So any accommodations that you can make, you probably have to have that in mind. It's not a case of a binary choice of which one is better than the other. So long as you address the key issues, I think any adjustment from where we are, because we are not in a good place, is basically acceptable. And I think it's a case of if you're sitting on a stool and it has a nail, you cannot say that it's pinching lesser than it was pinching last year. You have to address the problem and ensure that you take it out.
That's true. And just back to the debt issue, I think one of the key things that we've seen the government doing is to try and increase their taxes. And I was just looking at some numbers, and I was very surprised that Kenya collects more taxes than Nigeria, despite the the huge disparity in terms of economic size. Are we being too hard on our Kenya Revenue Authority and ourselves, or is this the only way that we can try and be able to cope with the situation that we find ourselves in?
When you're comparing the levels of tax collections as a proportion of GDP between Kenya and Nigeria, and you see ourselves being higher than Nigeria.
Actually, it was in absolute.
Yeah,
Absolute.
It simply tells you therefore that we are a much more diversified economy than Nigeria, and
Yes.
that's why the vulnerabilities that Nigeria has gone through.
Yes.
It's not the experience that we've had here.
Yes.
Now, to raise more tax revenue does not necessarily mean that you raise tax rates, because the elasticity, meaning the amount of money that you collect by increasing the tax rate, may not be that high.
Yeah.
You may actually raise tax beyond a certain threshold where it becomes even punitive for
Yes.
for consumption and for business.
Yes.
The endeavor to work on the tax rates,
Yeah.
while at the same time broadening the tax base, is probably a better bet towards breaching the gap that we have.
Yes.
That has obviously been necessitating that the government come to the market to borrow to meet its obligations.
Yes.
So that is one side of the story. The other side of the story is that you can only collect tax on the back of a thriving economy.
Yes.
And that is why now you have to start looking very carefully at how this growth rate has emerged. If the growth rate is driven more by public expenditure and not a thriving private sector, you'll continue having a problem of inability to meet debt targets. So if the private sector is complaining that they're not operating at optimum, and we are seeing growth, and some have argued that we are seeing the output gap closing, meaning we are growing as much closer to our potential, then you need to worry as to whether we are actually able to meet our revenue targets, much as we are collecting more than Nigeria in absolute numbers.
Yeah.
So I think looking at the local situation, we have to look at whether growth is coming from segments of the economy that can enable tax revenue to be realized.
Yeah.
And that is why I think some could argue that there's a disconnect between the very rosy growth numbers that are being painted and what's happening on the enterprise front. Yeah, so raising taxes to collect more revenue may be as much counterproductive as could be counterintuitive insofar as enabling the economy move forward.
Yeah.
That's not the same thing as saying that you don't need taxes. Taxes are very important because the government must of necessity have resources to be able to meet the public good that then can be at the back upon which enterprise and households continue thriving.
Yeah.
So it has to be a delicate balance.
Yeah.
Yeah.
Okay. Things I want to talk about a sector that is of great interest to you, and it's the banking sector. And the banking sector has been accused severally of under-provisioning. And I just wanted to know, what's your opinion on the Kenyan banks' credit quality?
Yeah, it's interesting you ask that because under-providing is interesting, especially when now the banking industry has gone into what they call the IFRS 9, which are much more forward-looking provisioning, asset classification, and I think much more stringent than what we had before. It depends on who is putting the accusation, because if the market was under providing, then you probably will see that being flagged from a regulatory standpoint. Yeah, because the audit process is not something that is not done within some given parameters.
Yes.
And I don't think it's intuitive to argue that the industry is under providing on the back of the increasing number of non-performing loans.
Yes.
Because the non-performing loans that typically used to be below 5% are now sitting above 10%.
Yes.
So you can't argue that the market is under-providing while we are seeing non-performing loans increasing.
Yeah.
So that is an accusation that I don't know where it comes from.
Okay.
And I also don't think that it merits being taken seriously.
Okay.
And another thing, of course, is to, if you under-provide, somebody else will argue that you're over-providing. So that you can understate your returns and therefore pay less tax. So it's a debate, but I think it's a meaningless debate because the reason why you should appropriately provide is to ensure that you have a good quality asset.
Yeah.
And as you know, the stability of the financial system such as ours and the banking industry in particular is a function of the quality of the assets that you hold.
Yes.
If you're holding dodgy assets in the name of wanting to appear that you're looking good, you probably be compromising stability.
Yeah.
And the market has been stable.
Yeah.
So that points to the fact, therefore, that any accusation of under-providing is not justifiable.
Okay.
Yeah.
Okay. And the Kenyan banks, through the Kenya Bank Association, recently launched the PesaLink platform. It was supposed to be M-Pesa's biggest rival in terms of mobile money transactions. And I think all of us were looking forward to this very exciting phase in the banking industry. I don't know, as somebody who probably has even played a part in this, how would you rate the success of the PesaLink today?
I think PesaLink as an institution can speak to that much more eloquently than I can. And I can't speak for them, nor can I speak for KBA. Yes. But all I can say is that I think from where I sit, it's not a product that is put in the market to compete with an existing product. That's true. It's an additional product to give customers an option. And that option includes, looking at a much more higher threshold than what the other players are able to do, meaning that there's already a missing market. Yes. And that is really the niche that PesaLink will be looking at filling, not necessarily to rival an existing market player. But as I said, I can also eloquently speak on that subject.
Yes. Okay.
Yeah.
And I think what we've seen recently, the NIC and CBA coming together, they recently announced the intentions to merge. And I know this, for as long as I've been in this industry, we've been talking about potential consolidation in our banking sector. Is this the beginning of what we've always been expecting to happen in the banking sector?
That's a good question, because anybody you talk to will talk about two main banks. They do some quick arithmetic that, if we have 42 million and you have 43 banks, you're looking at averagely
$1 million per,
which does not make a lot of sense if you ask me. Not the argument of just simple arithmetic does not make sense to me, because I think those who argue that way, if you ask them that, what will be the optimal number of banks that we need in an economy? They probably don't have an answer because they have not established one. I don't know whether it's because they don't like the number 43. But the reality is this, from where I sit, and this is really my personal view, so long as the market is stable, and so long as those institutions are actually serving a particular market segment, you cannot start determining that this number is higher than I could have loved. And that is why any moves that happen in the market must, of necessity, arise out of the market circumstances. We've had instances where, markets have failed, that we have too many institutions and they have forced consolidations. And you know how the story goes. Forced marriages usually have a problem. Fortunately for us, I think the mergers and acquisitions that we've seen in the market, the NICCBA is not the first one. I don't know why it's being seen as the... I mean, we've had recent mergers and acquisitions. We had a bank called Abib that was acquired by a Diamond Trust. Nobody talked about it. A few people talked about it.
Yes.
Jairo Bank was acquired by and that was an acquisition.
Yes.
So that simply tells you that the market has a way of adjusting. And that also speaks to the extent of the dynamism in the market. So if the NIC CBA merger were to be concluded, that will add the impetus of the market dynamism.
Yeah.
Remember that if you take an historical perspective, the Kenyan banking industry, 20 years down the road, what you used to call the top banks, by whichever criteria you want to look at, assets, profitability, are not the same banks that have been there. The position that international banks occupied in this market 20 years back is not the same position that they occupy right now.
No.
So what's happening on the mergers and acquisition front speaks to the dynamism in the market. And fortunately for us, both from a regulatory standpoint, from a policy standpoint, and from a market standpoint, we have an environment where market is allowed to adjust. That adjustment includes looking at what kind of partnerships you can make.
Yeah.
Mergers being one of them.
Yeah.
Whether this will trigger others thinking that way will depend on what kind of competition dynamics this introduces into the market.
Yes.
Because if this was to be concluded successfully, and there's no reason to believe otherwise, then you'll see the big player classification changing.
Yes.
And that has its competition dynamics. And that will now inform whether we'll see some of those things happening. So it remains to be seen how the market will respond to that.
Yes.
But there's another thing that is often not talked about, the motivation of either merging or acquiring. If you're basically looking for economies of scale, you have two options. You can you're operating. You can grow the business over time, or you can seek for partners such as those. If on the other hand you're looking at enhanced efficiencies and market positioning and more business and all that, then you can still go the same route. Look for partnerships. Or inject more capital and grow the business. So the bit about all this is that it's a market-driven initiative. There's nobody's hand forcing things which can cause challenges.
Well, thanks for that. And we can't finish talking about banks without talking about mobile money, mobile payments, which has completely transformed the banking sector over the last decade. And Kenya has been at the heart of it. I think the impact has been felt globally. And I was just wondering whether you foresee any other disruptive trends in our financial sector.
I think technology is now going to be at the core of banking now and going forward. You can say that banking has happened on the bed of technology, I mean, from the core banking systems. But I think now technology is increasingly becoming integral. The conventional way of doing banking, I think, is behind us. So embracing technology, either by creating that technology or by partnerships, is going to be the way going forward, because it brings an element of efficiency. It also brings an element of ensuring that banking going forward is more inclusive. I think the financial inclusion strides that we've made as a country have been on the back of technology, especially using mobile technology for purposes of offering financial products. And you can imagine that we've transitioned in a very fast space from using mobile technology simply as payments into now intermediation, where you can be able to save, you can be able to get credit. So that's the right space to be, and I think that will enhance the ability to reach people that have not been reached before. And it also has the ability to ensure that there's efficiency in the market. So it's a very dynamic space, and that dynamism simply means that disruptions will be the order of the day. So those who are on the frontier from a technology standpoint, from the analytics standpoint, because the other advantage it brings is that it enables you to get a rich pool of data that you can use for purpose of understanding the customers and therefore being able to proactively offer products that are amenable to them to support their aspirations.
Thank you so much, Jared. Maybe as a parting shot, what would be your conclusive remarks as far to investors who look at Kenya as an investment destination?
I think I'll say this. I'll say this. Kenya is a country that has demonstrable resilience, and is a country that, just like any other, has its own challenges. But we have a way of addressing our challenges, and that challenging environment actually makes us stronger than it weakens us, because without challenges, you can be very complacent. So on the back of those challenges, on the back of the resilience that we have, on the back of the ability to have our own solutions to our problems, including the handshake, I think gives you a good indication that no, this is a place to be, and this is a place to seek to put more resources if you're already here. So that's really what I can tell investors. Yeah.
Thank you for watching. Kenya is a resilient nation, and the handshake is one indicator of just how we have our own homegrown solutions. Thank you for watching. My name is Pius Mushiri Mugo, the Managing Director of Labo Capital, and you're watching Invest in Africa.